Welcome to the ProTicker Deep Dive.
It's good to be here. And honestly, looking at the absolute state of the industrial sector this week, this feels less like a deep dive and more like a critical briefing for anyone with money in the market right now.
Absolutely. Today is Tuesday, February 10th, 2026. And if you've glanced at your portfolio recently, especially that slice dedicated to defense, you're probably feeling a bit of whiplash.
A bit. I'd say a lot.
Because on paper, everything should be fantastic. Every analyst on the street is calling this a security supercycle. The world is, to put it mildly, a very dangerous place. Global demand for weapon systems, for missiles, for advanced defense technology. It's at an all-time historic high.
That's right. I mean, if you just look at the pure fundamentals, just the raw order backlogs for these companies, they should be printing money hand over fist. The demand signal, it hasn't been this strong since the absolute peak of the Cold War.
But the stocks are not reflecting that at all. They're acting like distressed assets. We're seeing this incredible acute volatility and just genuine anxiety from investors in a sector that's, well, it's usually the sleepiest, safest place to park your capital.
It's a total paradox. You've got record demand clashing with a record level of, I'd call it, regulatory fear. And that fear is forcing a massive and I think permanent repricing of the entire sector.
And that really gets to the core conflict we need to unpack today. It's a clash of cultures, really, a clash of philosophies.
Yeah, that's a good way to put it.
On one side, you have the traditional defense industrial base. Let's just call them the DIB for short.
Sure.
And for decades, they've operated on financial metrics. Earnings per share, shareholder value, keeping Wall Street happy with slow, steady, predictable dividends.
And on the other side, you've got the new Trump administration. Specifically, this very aggressive, very muscular new Department of War.
And we definitely need to talk about that name change in a minute.
Oh, we do. And this Dow W, as they're calling it, is operating on a completely different set of metrics. They couldn't care less about the stock price or the PE ratio. They care about production. They care about throughput. How many missiles rolled off the assembly line this week? That's their bottom line.
It's like the irresistible force meeting the immovable object. For literally decades, if you were an investor, these big defense contractors, your Lockheeds, your Raytheons, they were what we call bond proxies.
Safe as houses.
Exactly. You bought the stock, you held it, you collected your dividend check every quarter, and you slept like a baby. It was a guaranteed check from the U.S. government, passed through a corporation.
It was the quintessential sleep well at night trade. But that whole logic, that entire investment thesis, has just been turned completely on its head by a new executive order.
The government isn't just a customer asking for weapons anymore.
No. They are now actively threatening to freeze billions of dollars in shareholder payouts. I mean, to literally stop the dividend checks from going out the door if these companies don't start building things faster.
It's a shift from what you'd call a partnership of, mutual financial benefit.
Right.
To what you described in your notes as a high-stakes regime of performance-based accountability.
That's the, let's say, the polite boardroom way of putting it.
Okay, so what's the blunt way?
The blunt way is that the government is weaponizing capital allocation. They've stopped asking nicely. They are now directly targeting the one and only thing Wall Street truly cares about, the return of capital to shareholders. Because you can't pay your dividend, you are not a blue-chip stock anymore. You're a high-risk asset.
So let's get into the weeds here. We have to start with the document that lit this fire, the executive order from January 7th.
Right. This is the one titled Prioritizing the Warfighter in Defense Contracting. But, before we even dig into the actual text of the order, we have to talk about the branding, the psychology of it.
The nomenclature shift. You mentioned it already.
Yes. If you've been paying attention to the internal memos coming out of the Pentagon, the press briefings, even reportedly the new signage going up inside the building.
You're kidding.
No. The administration is very frequently and very deliberately referring to the department not as the Department of Defense, but as the Department of War, the Dow.
That sounds, it sounds so archaic, like something out of a 1940s newsreel.
It's completely intentional. Think about the words. Defense implies a passive, reactive posture. You defend when you are attacked. War implies active engagement. It implies mobilization. It implies production on a war footing. It's meant to set a psychological tone, not just for the military and the civil servants, but for the boardrooms of these contractors.
It's a message.
It's a huge message. And the core mandate of this January 7th order, it's basically a public indictment of the last 30 years of defense contracting. It explicitly asserts that these companies have prioritized, and I'm quoting directly from the text here, lucrative contracts, stock buybacks, and excessive dividends over actual performance and innovation.
They're saying the quiet part out loud. They're basically accusing these massive corporations of being better at financial engineering than at, actual engineering.
Precisely. And the stated goal is to, quote, revitalize the industrial base to maintain peace through strength. But here's the key. They are not just using rhetoric. They are using financial weapons to do it. And that brings us to the core mechanism of this EO, the concept of the performance-linked dividend.
Okay, this is the part that has every income investor I know breaking out in a cold sweat. So walk us through the mechanism. How can the government just tell a publicly traded company that they're not allowed to pay a dividend to their own shareholders?
Well, the whole private nature of these companies is being stress tested here. The EO states that if a contractor is found to be underperforming, and we absolutely have to note that that term, underperforming, is currently completely subjective and defined solely by the Secretary of War.
So there's no objective metric. It's just, I say you're underperforming.
Exactly. It's a judgment call. And if you get that label, you are effectively prohibited from doing two very specific things. First, buying back your own stock.
Which is the primary way they usually prop up their share price and return any excess cash to the market.
Correct. It's gone. And second, the big one, issuing dividends to shareholders.
That is the nuclear option.
It is the absolute nuclear option for a stock's valuation. Imagine for a second you're a pension fund manager. You manage the retirement funds for, I don't know, teachers or firefighters.
Sure.
And you rely on that fat quarterly dividend check from Lockheed Martin or RTX to pay your retirees. That's a core part of your strategy. Suddenly the government comes in and says, no, that cash isn't going to your pensioners. That money has to go into building a new factory in Ohio instead. It completely shatters the entire investment thesis for holding that stock. You cannot hold a stock that might be legally barred from paying you.
And it's not just the shareholders who are taking the hit here. They're coming for the corner office too, right? The CEOs?
Oh, they are. The order is very clear on this. It stipulates that all future contracts must link executive bonuses to operational metrics.
So not financial metrics.
Not financial. It's about, did you deliver the jet on time? Did the missile hit the target in testing? Not, did you hit your earnings per share target for the quarter?
Because, as we've talked about, buybacks can artificially inflate earnings per share.
Exactly. It's the easiest trick in the book. If you buy back $1 billion of your own stock, you reduce the total number of shares out there. So your earnings per share goes up, even if you didn't sell a single extra product. The administration wants to sever that loop completely. And to add an exclamation point to it all, President Trump took to Truth Social and suggested a $5 million hard cap on executive salaries for any firm that's deemed to be underperforming.
$5 million. I mean, look, for 99.9% of people, that's an unimaginable fortune. But for a Fortune 500 CEO who is used to making 30, 40, 50 million a year in total compensation, that is a massive, massive pay cut.
It's a rounding error for some of these compensation packages. Now, we need to be very clear about this. That specific $5 million number is not in the legal text of the executive order.
Okay, so it's not law.
It's not law, but it sets the tone. It's the sword of Damocles hanging over every single boardroom. It's the White House saying, we are watching your paychecks and we are not impressed.
Okay, so they have the threat, a very credible threat. But governments make threats all the time. What's the actual enforcement toolkit here? How do they make this stick without having to pass a whole new law through a divided Congress?
They're digging deep into the toolbox and dusting off some old tools. The first one is the Defense Production Act, the DPA. The Dower can use the DPA to force prioritization of government orders. And people tend to forget, the DPA has real teeth. Willful violations can carry criminal penalties. We're talking up to a $10,000 fine, which is, nothing to a corporation.
Right, that's lunch money.
But it also carries up to a year in prison.
Wait, prison time. So you're saying we could be talking about potentially putting a supply chain manager or a VP of operations in handcuffs because a shipment of microchips was late?
Potentially. Is it likely? Maybe not. But the threat is there. It forces compliance through fear. But honestly, that's not even the scariest part for the companies.
There's another layer.
There is, and this is the one that really has the general counsels at these firms losing sleep at night. The EO explicitly directs the SEC, the Securities and Exchange Commission, to get involved.
The SEC, how do they fit into a defense production problem? That seems like a completely different world.
That's what makes it so clever and so dangerous. The order directs them to consider stripping any contractor deemed underperforming of their safe harbor protections. Specifically, a rule called Rule 10b-18.
Okay, you're going to have to break that down for us.
Yep.
Explain Rule 10b-18 like I'm 5. Why is that specific rule so important?
Okay, simple as I can make it. When a company buys back its own stock, it is, by definition, creating artificial demand for that stock. You're a huge buyer in the market. Technically, that's a form of market manipulation. Rule 10b-18 is a safe harbor that the SEC created. It basically says, look, if you follow these very specific guidelines on how you buy back your stock, don't buy too much at once, don't buy it right at the market open or the market close. If you play by these rules, we promise we will not sue you for market manipulation.
So it's basically a get-out-of-jail-free card for stock buybacks.
It is the get-out-of-jail-free card. And this executive order is now saying, if your missile production is lagging, maybe you lose that card.
So if you're an underperforming company and you try to do a buyback,
you could be charged by the SEC with felony market manipulation. It makes buybacks legally radioactive. No board of directors on the planet will authorize a stock buyback program if they think there's even a small chance the SEC might come after them with fraud charges. It effectively shuts them down without having to pass a new law.
And there's one more piece to this enforcement toolkit, right? The timeline.
The timeline. The 15-day shot clock. Once the Secretary of War points a finger at your company and says, you are officially underperforming, you have only 15 calendar days to submit a formal board-approved remediation plan.
15 days, that's barely enough time to schedule an emergency board meeting, let alone diagnose and create a credible plan to fix a multi-billion-dollar global supply chain.
It's designed to be impossible. It's designed to create a crisis. It forces the board of directors to drop everything else, all their other 5-year strategic initiatives, their M&A plans, everything, and focus 100% of their attention on solving the Pentagon's problem right now.
So that's the setup. This incredibly potent order dropped on January 7th. It gave the Secretary of War 30 days to identify the first round of bad apples.
Yep.
That deadline was, let's see the calendar, that was last Friday, February 6th.
That was the day everyone in the industry was dreading. The day of judgment, they were calling it.
The expectation was that we'd get a naughty list. Yeah. A press release naming names, shaming companies, and effectively crashing the stock prices of anyone on it.
Right. Everyone was braced for impact.
Friday came, Friday went, what happened?
Absolutely nothing. Crickets. Yeah. Total silence from the Pentagon. No list was released on the deadline. Then, yesterday, which was Monday the 9th, the Pentagon put out a short statement announcing an extended review period.
So help us interpret that. What does that mean? Did the government blink? Did they make this huge threat, and then, when it came time to pull the trigger, the Department of War backed down?
It's really tempting to see it that way.
Yeah.
To think they lost their nerve. But I don't think they're backing down at all. I think they're negotiating.
Negotiation implies that both sides have some leverage. What possible leverage could the contractors have when the government holds all these cards?
The leverage they have is the fragility of the American financial system itself. Look, I think the administration, for all its tough talk, realizes that if they abruptly halt the dividends for blue-chip bedrock stocks like Lockheed Martin or General Dynamics, they could cause a genuine market crash. These stocks are cornerstone holdings for pension funds, for 401ks, for countless dividend-focused ETFs that retirees depend on. If you shock that system too hard, you hurt the very capital base you need to fund the new factories. You end up driving up the cost of capital for the entire industry.
So if you hit them too hard, you make it too expensive for these companies to borrow the money they need to build the things you want them to build.
Exactly. You shoot yourself in the foot. So what we're seeing now, I believe, is what some are calling a mollification strategy. There are very detailed, very high-stakes negotiations happening behind closed doors right now. And the consensus emerging among analysts is that we're heading for a kind of split decision, a compromise based on this buyback versus dividend nuance.
Okay, break that nuance down for us. What's the difference?
From the Pentagon's perspective, stock buybacks are seen as fundamentally poor uses of cash. If you have $1 billion of free cash flow and you use it to just buy your own stock, that money vanishes from a production standpoint. It didn't build a new factory. It didn't hire a new engineer. It didn't fund R&D. The administration absolutely hates buybacks. So those are very likely going to be sacrificed, paused, at a minimum.
But dividends are different.
Dividends are viewed differently, yes. They're seen as a long-standing promise to the actual owners of the company. They're baked into the valuation. So analysts believe the quiet compromise that's being hammered out is something like this. You will stop the buybacks. You will put that cash directly into your factories, into CapEx. And if you do that, We will let you keep paying the dividend to prevent a complete shareholder revolt and a market collapse.
So the message is, we're not going to kill the patient, but we are putting them on a very strict diet.
That's a perfect analogy, and we can actually see this playing out in real time with the big prime contractors. They are not waiting for the list. They are making aggressive moves right now to get ahead of this, to prove they're on board.
Let's get into those case studies because the corporate responses have been fascinating. Let's start with RTX, the company formerly known as Raytheon.
RTX is absolutely in the hot seat. They're front and center. President Trump explicitly called them out by name on his social media platform, saying they were being the least responsive to the Department of War. That is a direct target painted on their back.
Ouch, you can't get much more direct than that. So how did they respond? Did they try to fight back, defend their record?
No, you can't fight the customer who buys 90% of your product and also regulates you. They pivoted, and they pivoted hard. First, their CEO, Christopher Kallio, came out and publicly, very strongly, affirmed their commitment to the dividend. He had to do that first to stop the bleeding in the stock, to calm investors and say, don't worry, your check is safe.
Okay, so that's step one, calm the market.
Step two was to open the corporate checkbook for the government. They massively increased their capital expenditure plan.
Their CapEx.
Right, significantly. For 2026, their plan for investing in new facilities and new factories, their CapEx was projected to be about $2.6 billion. They just bumped that up to $3.1 billion.
So that's an extra $500 million, $500 million being poured directly into concrete and steel and machinery.
That's $500 million. That is not going to stop buybacks. Precisely. And in return, or at least concurrently, they announced a massive new deal with the Pentagon to aggressively ramp up production of 5 very specific high-demand weapons.
Which ones?
The Tomahawk cruise missile, the AMRAAM air-to-air missile, the Standard Missile-6, and 2 variants of the Standard Missile-3 interceptor.
These are the heavy hitters. These are the exact missiles that are being used in conflicts all over the world right now, the ones everyone is trying to restock.
They are the key stockpile weapons. So the strategy for RTX is crystal clear. Throw a lot of money at the problem, show the administration you're serious about investing in new capacity, and hope that that buys you enough goodwill to get off the naughty list and keep your dividend flowing. It's essentially pay to play for your own stock stability.
Okay, so that's the RTX playbook. What about the biggest of the big, Lockheed Martin?
Lockheed is a fascinating case. It's really a tale of 2 cities right now inside that company. On the one hand, you have the F-35 program.
The jet that famously eats budgets for breakfast.
It's had a rough go. A Pentagon Inspector General audit that was released late last year, early this year, absolutely slammed the program. I mean, it cited poor oversight, a lack of basic readiness metrics, failure to enforce material inspection from suppliers. It was a brutal report. If there's a prime candidate for that underperformance label, the F-35 program is it.
That sounds incredibly dangerous for them. If the F-35, their flagship program, gets officially flagged, that's a gigantic chunk of their revenue that's suddenly at risk.
It is. It's an existential threat to their valuation.
Yeah.
But, and this is huge, but Lockheed has an offset. While the F-35 struggles, they are absolutely crushing it on missile defense.
This is what some analysts are calling the Golden Dome strategy.
Right. It's this idea of building a protective missile shield. And Lockheed just signed a landmark long-term deal to quadruple, not double, quadruple their production of THAAD interceptors.
Quadruple. From what to what?
From a rate of about 96 interceptors per year to 400 per year over the next 7 years. It's a colossal ramp up. And on top of that, they're tripling production of their PAC-3 missiles with a target of hitting 2,000 of those per year by 2030.
So the message they're sending to the White House and the Pentagon is, yes, we know the jet in the corner has some issues we need to fix, but look over here. Look at all these shiny, high-demand missiles we're building for you.
That's essentially it.
Yeah.
They are actively raising their 2026 financial outlook based on this incredible missile demand. They're trying to prove that they are part of the solution, not the source of the problem. They're positioning themselves not as a struggling aircraft maker, but as the indispensable arsenal of democracy for missile defense.
Now, the third case study is, I think, the most interesting and maybe the most forward-looking. L3Harris. They're not just increasing CapEx or highlighting a different program. They're doing something completely different.
L3Harris is playing 4D chess here. They are doing something structurally different. They are spinning off their entire solid rocket motor business into a brand new standalone public company.
Why do that? Why spin it off? Why not just, build more rocket motors inside the existing company?
because the entire U.S. defense industrial base has a full-blown crisis in solid rocket motors. These are the engines. They are the essential component for virtually every missile we make. And for years, due to consolidation, it's been a duopoly. Just Northrop Grumman and L3Harris made them at scale. It was a massive bottleneck. Lead times are getting longer and longer. The Department of War desperately wants more competition and more capacity. So L3Harris comes to them and says, fine, we will create a new competitor for you. We'll make it a separate company.
And the government's response is to invest in it.
This is the truly wild part of the story. The Department of War is investing $1 billion directly into this new spin-off company.
Wait a second. The government is buying equity. They're buying stock in a defense contractor.
They are buying something called a convertible preferred security.
Okay, we need to pause and explain that. That's a term most of our listeners probably haven't heard. What is a convertible preferred security, and why is the Pentagon buying it?
It sounds really complex, but think of it like this. It's an investment instrument that's usually used by venture capitalists or private equity firms when they invest in a startup. Preferred means that if the company pays dividends, they get paid first, before the common shareholders. And convertible is the key part. It means that at a certain point in the future, the government has the right to convert that security, which is kind of like a loan, into actual stock ownership, into equity.
So the Pentagon is literally acting like a venture capital firm, providing seed money to a startup.
Yes. They're capitalizing the business. They're not just being a customer buying the weapon. They're buying a stake in the factory that makes the weapon. They're putting skin in the game.
And L3Harris's plan is to take this new missile business public with an IPO?
That's the plan. An initial public offering sometime in the second half of 2026.
So why does this matter so much? What's the bigger picture here?
It matters because it represents a completely new model of government-industry partnership. Instead of just complaining about a lack of competition, the government is actively engineering the market. They are acting like a strategic private equity partner to force-feed capital and competition into this critical solid rocket motor market. It's a way to break the bottleneck, and for L3Harris, it lets them look like the trusted disruptor, the one who came to the table with a creative solution to a critical national security problem.
It really just underscores how desperate the need for these rocket motors is. I mean, just throwing procurement dollars at the problem wasn't working. It couldn't fix the lead times. They needed a fundamental structural change.
And that's a perfect segue into the broader economics of this whole security supercycle. Because we need to remember, despite all this regulatory fear, despite the naughty lists and the dividend threats, the underlying business for these companies is absolutely booming.
Right. Demand is not the problem.
Not even remotely. We have active or simmering conflicts on three major fronts. You can imply Russia-Ukraine, the ongoing tensions in the Middle East, and the strategic competition in Asia. The demand for systems like TOD and PAC-3, it's not cyclical. It's a virtually guaranteed multi-year revenue stream.
So then we get to the big question. If I'm an investor listening to this, I'm thinking, shouldn't I be buying this dip with both hands? If these companies are selling every single thing they can possibly make, why is the stock price going down?
That is the valuation trap.
Yeah.
And to understand it, you have to look at how these stocks were priced before all this started. They were priced as bond proxies.
Low volatility, safe, high dividend yield.
Exactly. Now they carry execution risk.
The risk that the government is going to step in and interfere with the business.
It's the risk that future profits will be forcibly reinvested back into the factory floor instead of flowing into your pocket as a shareholder. And what that's causing is a massive derating of the entire sector.
Explain what derating means in this context.
It's when the price-to-earnings multiple, the PE ratio, shrinks. So let's say a stock used to trade at 20 times its annual earnings because everyone agreed it was a super safe, predictable business. Now, because of all this new political risk, investors are only willing to pay, say, 15 times its earnings. So even if the company's earnings go up, the stock price can actually go down because that valuation multiple has collapsed.
So the market is essentially saying, we don't trust the quality or the accessibility of these earnings anymore.
That's it in a nutshell. Investors are terrified that free cash flow, which is the cash left over after you pay all your bills and make your investments, is going to shrink because CapEx is being forced higher. We're seeing this in all the analyst notes. Goldman Sachs put out a report predicting that defense buybacks in 2026 will be significantly below 2024 levels. And their reasoning: a regulatory blackout. Companies are simply too scared to authorize buybacks while the Dow is watching them this closely.
And I saw a note from JP Morgan that said something similar. that even though cash flow is incredibly strong from all the new orders, buybacks are the first and easiest casualty in this new environment.
Even the companies themselves are telegraphing it. General Dynamics and Northrop Grumman have both signaled in recent calls that they're pausing or being very cautious on buybacks to focus their capital on R&D and production capacity. The party isn't over, but the open bar for shareholders is definitely closed.
Now, just to make things even more complicated for these companies and their investors, there's another acronym we need to talk about. We've spent a lot of time on the DoW, the Department of War. Now we have to talk about DOGE.
Right, the Department of Government Efficiency.
This really feels like a classic pincer movement. On one side, you have the Dow yelling, speed up, spend more money on factories. And on the other side, you have DOGE yelling, cut costs, stop wasting money.
It is a perfect pincer movement. While the Department of War is pushing for more, faster production of hardware, DOGE is pushing for more efficiency and cuts on the services side of the government. And of course, there's a specific executive order for this too, EO 14222.
And this one requires a line-by-line review of government contracts to find waste.
Correct. They are going on a huge waste hunting expedition. And they're specifically targeting two areas: small business set-aside contracts that are over $20 million and large government service contracts. Think IT consulting, management advisory services, that sort of thing.
All the Beltway Bandit stuff, as it's sometimes called.
Exactly. The companies that provide the IT help desk support for the Pentagon, or the ones that do strategic consulting on procurement reform. We're talking about companies like Leidos, or even the huge IT services arm of a prime like General Dynamics.
So if you're a company like General Dynamics, you're getting yelled at by the DoW to build your submarines faster, which costs more money, but at the same time, your $100 million IT services contract might get cut in half by DOGE for being wasteful.
It creates this incredible revenue uncertainty, and the deadline is coming up fast. The order says that terminations for convenience are expected to be issued by February 28, 2026. That is the end of this month.
Termination for convenience, that's a very specific legal term. What does it actually mean for a company?
It's a standard clause that's written into almost every federal government contract. And what it means is that the government can cancel your contract at any time, not because you did anything wrong, but just because they don't want or need it anymore. It's like if you hire a contractor to remodel your kitchen, and halfway through the job you just say, you know what, I've changed my mind, stop working. You have to pay them for the work they've already done, but all that future revenue they were counting on is just gone.
And they don't have to prove any fault or breach of contract on the company's part.
No fault is needed. It's purely at the government's convenience. So these big diversified defense companies are facing this brutal double threat. You have regulatory pressure on the hardware side of the business, forcing them to spend more. And at the same time, you have massive budget pressure on the services side of the business that could cause them to earn less.
It's a real tightrope walk. And we've mostly been talking about the big guys, the primes. We haven't even really touched on the little guys. The vast, sprawling supply chain that feeds them.
The flow-down effect. This is absolutely critical to understand.
Because that executive order, it applies to defense contractors. It doesn't say just the big five primes.
And legal experts are all warning that this pressure flows downhill. Think about it. If Lockheed Martin is getting squeezed on speed, if the Pentagon is telling them, deliver the next block of F-35s faster or you will lose your dividend, what is Lockheed going to do? They're going to turn around and squeeze every single one of their suppliers.
They're going to call up the small company in Michigan that makes the landing gear and say, you need to deliver this 30% faster, or we're canceling your contract and finding someone who can.
Exactly. The strict terms, the deliver or else pressure, it all flows down to the smaller manufacturers in the sub-tiers. But here's the fundamental problem. Those smaller companies don't have the deep pockets of a prime contractor. They don't have a spare $500 million to just throw at CapEx to build a new production line.
So we could actually see a real crunch at the bottom of the supply chain, bankruptcies even.
You could see bankruptcies. You could see more consolidation as the healthy suppliers buy the struggling ones. Or you could see critical suppliers just fail, creating even worse bottlenecks. It is a very, very dangerous time to be a sub-tier supplier if you aren't performing absolutely perfectly.
Let's circle back for a second to that L3Harris spinoff and the solid rocket motor crisis. You said it was a bottleneck. Can you give us a little more history on how we got here? Why was the supply so constrained in the first place?
Sure. It really goes back to the end of the Cold War and what's famously known as the Last Supper in the defense industry back in the 90s.
The famous dinner where the Secretary of Defense sat everyone down.
Yes. The Pentagon leadership basically gathered all the CEOs of the major defense contractors in a room and told them, look, the Cold War is over, the peace dividend is real, we don't need all of you anymore, the budget is shrinking. So your choice is to merge or die.
And they did. We saw this massive wave of consolidation.
A huge wave. Dozens and dozens of independent companies merged and were acquired until we were left with a handful of giants we have today. And in that process, we ended with very few suppliers for critical subcomponents. For solid rocket motors, we ended up with essentially two, a duopoly.
And then when the conflicts in Ukraine and the Middle East flared up and demand for missiles went through the roof, we suddenly realized that two suppliers wasn't nearly enough.
We realized that the efficiency that was created during peacetime also created extreme fragility for wartime. We had optimized the entire system for low cost and just-in-time delivery, not for surge capacity. So the L3 Harris spinoff, backed by that $1 billion government investment, is the government actively trying to reverse 30 years of history. It's a desperate measure. It's a public admission that the free market, left to its own devices under the previous set of rules, failed to provide the industrial base the nation actually needs.
So the government has to step in and effectively create the competitor that it needs to exist.
Yes, they are no longer just a referee of the market. They are an active player, trying to engineer the market structure itself.
This all really brings us to the biggest picture. What we're watching here feels like a fundamental, maybe permanent shift in what it even means to be a defense company in America.
I think we are. We're absolutely moving away from a growth-through consolidation model, where you got bigger and more profitable by buying your competitor and ruthlessly cutting costs. And we're moving toward an industrial performance model,
where you get rewarded for actually building things on time and on budget.
What a novel concept.
Right.
But the implications of that shift for an investor are just profound. The government is no longer a passive customer. They're not just writing a check and then waiting patiently for delivery 5 years later. They are now an active, and I would say, aggressive manager of corporate governance for this entire industry.
They are effectively sitting in the boardroom with these companies.
They're telling the board of directors how to allocate their capital. No more buybacks. Cap your executive pay. Reinvest that money into new factories. That is a level of direct government intervention in publicly traded companies that we have not seen since maybe World War II.
So let's bring it all home for the listener who's tuning in. The person who has LMT or RTX sitting in their retirement portfolio right now, what is the ultimate so what here for them?
The so what is that the fundamental rules of the game have changed completely. If you are holding these stocks for safe, passive, predictable income, you need to wake up and reassess. The dividend is no longer guaranteed by the government contract. It is now contingent on the performance on the factory floor.
So you have to start watching the production numbers and the delivery schedules just as closely as you used to watch the quarterly earnings report.
You absolutely do. And you have to accept a higher level of volatility. This derating that we're seeing, this phenomenon where the stock prices are dropping even though the business is booming, that's the market struggling in real time to figure out how to price in this entirely new category of political risk.
It's a massive real-time experiment. Can you use command and control tactics on a free market sector and force it into efficiency by holding a gun to its stock price?
That is the multi-trillion-dollar question. Will this actually work? Will it result in more missiles being produced faster? Or will it just scare away private capital, drive up borrowing costs, and actually make the problem worse in the long run? If investors flee the sector because it's suddenly too risky and unpredictable, then the cost of capital goes up for everyone, and it becomes even harder and more expensive to build those new factories.
It's an incredibly high-stakes gamble.
It is. And that leads me to a final provocative thought to leave you with as you watch this unfold.
Let's hear it.
We are now seeing the Department of War investing directly in the equity of companies, like with the L3 Harris deal. We are seeing them openly suggest caps on executive pay. We are seeing them dictate corporate capital allocation policies. So the question is, are these really private companies anymore?
That's a very heavy question.
Or are we witnessing the de facto nationalization of the American defense industrial base, just happening quietly under the guise of efficiency and prioritizing the warfighter? If the government is pulling all the most important strings, what you build, how much you pay your people, what you do with your profits, does it even matter who technically owns the stock?
That is definitely something to mull over.
Yeah.
The line between a public company and an arm of the state is getting very, very blurry in the defense sector.
Indeed it is.
Well, on that rather cheery note, I think we're going to have to wrap up this deep dive. It is a fascinating and incredibly complex and fast-moving time to be watching this sector. We will certainly be keeping a very close eye on what happens with that naughty list and the end of this so-called extended review period.
It is going to be a very busy rest of February, that's for sure.
Thanks for listening. We'll catch you on the next deep dive. Stay curious.